There's two sides to the phrase. Markets love to climb the wall of worry and then they slide down the slope of hope. And I think for most of this year, they've done a great job of dealing with trade, Trump, Brexit, Italexit, China, strong dollar, geopolitics. Obviously, things are begun to get a little bit wobbly in the fourth quarter of this year, but I think a lot more of that is related to the Fed's withdrawal of liquidity. I think the biggest challenge is the fact that very, very few assets have actually done well this year in sterling total return terms. All that's outperformed cash is really Japan and US equities. Nothing else has. It's been a very tricky year, so it's not been as easy as we would have liked to think it's been. And for the US, you've had narrowing breadth, and you've now got rising interest rates, rising dollar, rising oil prices, rising wages, challenging record corporate profits and expectations of very strong earnings growth. So I think if there is anything to worry about, it's the fact that expectations are now so high in the US, maybe, just maybe, that's finally the tipping point for what's been a brilliantly performing asset class again this year, confounding the doubters. Liquidity has been so important to markets for most of the last decade because asset prices have feasted on cheap liquidity. Central banks have pumped in $10, $12 trillion worth of extra liquidity over the past few years. That has forced interest rates down, reduced cash to nothing, and forced money into assets where perhaps it might not have otherwise gone. That has lifted all boats: stocks, bonds, property, horseflesh, art, wine, pretty much you name it. So now the Fed is withdrawing that. The Bank of England has stopped adding. The European Central Bank is about to stop adding. The Bank of Japan is maybe even having second thoughts. That liquidity tide is starting to go out. It can't possibly be a coincidence. That's why I've started to see higher volatility, and therefore, again, I think you'd expect more volatility going forwards, particularly with the Fed at the moment so determined to keep withdrawing stimulus, try and normalise policy before the economy starts to slow down. I'm concerned about inflation because nobody's talking about it, and therefore you naturally look for unknown unknowns and think, well, maybe what could blindside things. Advisors are in the business of helping clients sleep in their beds at night, so you're always looking for what can be the black swan, the big nasty surprise. Yes, we're right to worry about deflation. Global debt is a third higher than it was a decade ago. Western demographics are not great. Productivity is a big question mark. Nobody's really asking me about inflation, even though employment is low, wages are creeping up. There's still lots of liquidity out there. There are things that could just creep out. Who's to say QE, since its introduction, hasn't helped inflation? Who's to say QE's withdrawal doesn't actually promote it? Perverse things can happen from unusual policies, and I just think with nobody focused on inflation, it could be the one big blindside surprise. Inflation's return, if it does happen, and no promises, it would mean back to the 1970s, and that really wasn't much of a fun time to be an investor at all. The assets that did best then were gold, and anything you could stick down your throat or stick down the sink. Consumer staples, basically. So it's very different from where we've really been recently. If you look at what's thrived, really since over the last 20 or 30 disinflationary years, it's been a 60-40 allocation equities to bonds, it's been long duration bonds, it's been growth stocks, it's been momentum. If the 70s are any guide, none of those strategies will work particularly well, so it would require a fairly major rethink if, and again no guarantees, if inflation finally crawls out of the woodwork.